Thanks very much for coming. This evening what we're going to talk about is basic finance and in particular basic budgets for chemists, for researchers and for people in the chemical industry. So we're going to try to demystify a little bit about money and finance and all these things. Some of you who might be interested in starting companies, working in industry will find this useful, but actually those of you who have an academic career in mind, I think will also find it useful because you have to do this stuff in most grant applications these days. So money. Money is all about, if you like, controlling what it is that businesses do and what businesses want. Okay? What do businesses want? If you're a small business, what you want to know is basically how much cash do I have in the bank? Can I afford to pay myself? Can I afford to go on holiday this month? Right? Can I keep the company going? On the other hand, you hear larger companies talk about the profit. Now, what's profit? Is that the same as cash or is that different to cash? The Royal Bank of Scotland made £10 billion profit last year. Oh, no, it didn't, but there you go, right? You know, is that a lot? Is that a little? What does that mean? And then you hear people talk about return on investment, or even more scary, return on capital employed, right? What's all that stuff? Okay? And you hear senior managers of companies justifying their exorbitant salaries by talking about superb returns on capital and growth and sustainable growth. Okay? Well, what we have are a range of financial statements and financial data that help us get a kind of handle on all these things. Okay? The profit and loss account, what it tells you is how much profit the company made last year or in its last accounting period. Right? It's, if you like, a historic document. In some cases, it's very historic because companies actually have 9 months after their year end to file their accounts. So in some cases, you look at a company's accounts and the last profit and loss account you have can be over a year old. Okay? But profit is what we made last year. On the other hand, you'll hear something called a balance sheet. A balance sheet is, if you like, a little snapshot of where the company is now after last year's profit, but also after all the previous year's profit. A balance sheet takes into account all of the assets of the company, the good things, the things that the company owns, the things that it could sell, its factory, right? The people that owe it money, its cash in the bank, those are all assets. And it takes away from the assets the liabilities, the bad things, the total amount of money it owes to its suppliers, bank overdrafts to the taxman. Right? And it compares the assets with the liabilities. You hope the assets are bigger because the bit that's left over, the difference between the two, is the value of the company to the shareholders. The shareholders' assets, the shareholders' interest. Okay? And when you buy a company, what you're doing is buying the shares. And you occasionally hear of companies changing hands for a penny, usually a football club. And that's because actually the liabilities are rather bigger than the assets. And then we talk about looking into the future. Okay? If a profit and loss account is what happened last year and a balance sheet is where we've got to now, then a budget is what's going to happen this current year. What's going to happen if all goes according to plan? That's what a budget is, and that's why you have to put a budget into a research proposal. Right? If all goes according to plan, this is how much money we're going to spend. And these will be all the great things we'll get from it. And then there is a fourth type of financial analysis, which is looking further ahead than 1 year. Looking ahead 2, 3, or 5 years. And this is where companies say, look, you know, our business has a problem. We don't sell anything in Japan. Perhaps we should buy a Japanese company. Perhaps we should enter that market. Perhaps we need a major program of capital investment. Perhaps we need fantastic new labs. That's going to cost us quite a lot of money. over a long period, but in the long term, the rewards will be great. Right? And big companies do that. Investors do that. Governments do that. Can Scotland afford a new Forth Bridge, for example? And the way we do that is by a type of financial analysis called investment appraisal. And you might hear people talking about discounted cash flows and net present values, which sounds scary, but we will touch on those. So let's talk about profits to start with. What's a profit? Well, a profit is simply a big subtraction sum. It's the difference between all the income, all the sales, all the money coming in, and the costs, the expenditure, all the money going out, right? In principle, it's very simple. However, there's one sneaky thing they do. You know, when you deliver products to someone, you deliver that product, but you don't necessarily get paid for it at the time. Typically, you send someone an invoice, but you might not get paid until the end of the month. Or if you're sending something to a university, typically the end of the following month, because they're like that. Okay? We calculate profits at the point that we send the invoice, not the point at which we get paid. When someone sends us an invoice, we write it into our profit and loss account as an expense the minute we get the invoice, not when we pay them. Okay? What else do we know about profit and loss? Well, we try to compare all of the income and all the expenditure over the same period. So if we're calculating profit, say, for 1 month, and we have a 3-month phone bill, we need to do something with that 3-month phone bill, don't we? We need to split it up. Yeah. If we buy a very large item during that particular year where we're trying to calculate the profits, if we buy a new building, a new laboratory, new company cars, and we know it's going to last for a long time, then we don't just deduct the cost of that in one big go. We say, this item is going to last for 5 years, and so we spread the cost out over 5 years, right? And that act of spreading out the cost is called depreciation, right? It's what we do with large things. And the final thing we have to remember is at the end, we get a sum called profit that we think is right. We then take it to our accountant, if you're a small business like me, or the company accountant, if you work for a large company, and say, this is how much profit we've made. And the accountant changes it a bit, tells you what you can and can't do, and says, this is the taxable profit. You're going to have to pay tax on this amount of money. If you're a small business, that's 20%. If you're a large business, it's 30%. If you're a charity, like the University of Edinburgh, you don't pay tax, which is good. So, that seems easy in principle, doesn't it? Let's have a look at a little example. Right? Let's take a very small, simple chemical company. Right? And this is called Smith-Ken Limited, founded by Joe Smith. And it's a little one-person consultancy. It advises chemical industry customers on safe materials handling, health and safety, right? Classic consultancy. In January, Smith-Chem does one project for Megachem plc and has received payment of £2,000 for this work. It has done some work for Midshire University and has invoiced them £1,500, but it haven't been paid yet. They have received an order to do work for Little Chem Limited, estimated at £2,500, but that's expected to take place in February and to be paid in March. Expenses. In February, Joe visited Megachem, spending £40 on travel, Midshire spending £50, and Little Chem spending £60. Smith-Chem has one part-time employee whose salary costs are £6,000 a year. It received a telephone bill in early February relating to the 3 months ending on the 31st of January. That was £300. It carries various insurances totaling £600 per year, paid on a monthly direct debit basis. It operates from a small office costing £600 rent per quarter and it has £5,000 of office equipment, furniture and PCs, which will fully depreciate over 5 years. Okay? Now, for any of you interested in ever doing something like a business studies degree or an accounting degree, this is the kind of thing that you get pretty early on as a kind of example, how to calculate profit. Okay? Have any of you had a go at this and had a look at the numbers? Okay. What do we get as the total sales of Smith Chem Limited? Do we get 3,500? Great. Okay. And why is it 3,500? Because we count the amount of £1,500 that's invoiced even though it's not received yet. Good. Okay. What about the costs? What are the total travel costs? £150. Great. Okay. How much is the rent per month? £200. Good. What about the monthly wages? Okay, do we have 500? Good. What about the telephone bill? How much are we going to put in for the telephone bill? £100. Why? Right? Because we're taking a 3-month bill and splitting it because we've been asked to calculate the profit for 1 month. Okay? Good. And what about the depreciation? I'll do that for you if you like. Okay? Depreciation is £83.33. There we are. That's because it's £5,000 fully depreciated over 5 years, which is 60 months. And that's what the sum comes to. The profit that Smith Chem has made in January is £2,416.67. So here's my question. Can Joe Smith go on a skiing holiday? Because that was the thing. Joe said, I've had a really good January. Can I go on a skiing holiday in February? Right. Joe Smith could actually almost be me because this is just about the identical decision making that I go through. Right. Do we think that Joe Smith can actually go on holiday? It's made £2,400 profit. He doesn't have the money yet, yeah. So what he's done, or she, because we don't know if Joe is he or a she, what Joe has done is said to the accountant, will you calculate the profit that I made in January? And the accountant has done absolutely that, because that's what accountants do. Accountants are very clever and useful people, but they're just like computers. If you ask them a very specific question, they'll give you a very specific answer. What was the profit that we made? The profit that we made is £2,416.67. And you notice the wonderful, probably spurious precision here. You notice that if we just invoiced something a little bit later, the profit figure would be different. If we calculated our depreciation over 6 years rather than 5 years, the profit would be different. If we decided to split our telephone bill up in a different way, instead of dividing it into 3 equal months, it's conceivable that we would actually look at the telephone bill, which is itemized, and say to ourselves, look, we didn't actually use it very much in December because it was Christmas, and we did use it a lot more in January. And you can see how the profit would change. So what do we want to know instead? What we want to know is how much cash, how much spare cash Joe has in the company. How much spare cash is there that Joe can spend in February? Okay. So how are we going to change that calculation? What are we going to change about the sales? We've only got 2,000 of sales because we're not getting paid until the end of the month because that's what universities do, right? The travel is the same. What about the rent? That is January's rent.
The rent becomes zero.
So, no, we still have the rent for January, but we also have the rent for February, right? Because the question we really want to know is, can we afford to take money out of the company in February? So instead of, it's not zero, instead of £200, we get another £200. Okay? Insurance might go up. What about the telephone? It's, what we have is a telephone bill in February of £300 relating to the 3 months. Right? On a profit basis, we spread it out, but on a cash basis, it's a big chunk of money that comes out in February. George, you have a question.
So yes, if you pay the rent per quarter, do you have to pay in 1st of January? Or do you have to
It varies. It varies. Do we pay the rent at the 1st of January? It can be a number of different dates. It's a commercial arrangement between the company and the owners of the property. Yeah. If we look at the cash flow and then do that sum, roughly, how much cash we got from sales? £200. We spend cash in January, travel, rent, insurance, and wages. We spend cash in February, rent, insurance, and wages, plus the 3 months phone bill. How much money have we now got spare in the company? £50. It's not a skiing holiday to San Moritz, is it? It might be 1 day in Glen Shee, providing he's starting in Blairgowrie. Okay? It's not a lot more than that, is it? What does that tell us about the relationship between profit and cash in a company? Are they the same thing? Nope, right? If there's one thing I'd really like you to remember from this exercise, profit and cash are not the same thing. If you ever have to run your own little business or you're head of a group, even a research group, you have to understand that. Right? What Joe wanted to know was, can I afford to go on a skiing holiday? What Joe asked was, how much profit did I make? What Joe should have asked was, how much spare cash do I have? Right? Remember I made that comment about accountants doing exactly what you asked them to? Did you ever hear the story about the man in a hot air balloon? And he goes up in a hot air balloon and all the clouds come underneath. And he doesn't know where he is. And he sees one little gap in the clouds and he shouts down and says, "Hello, hello, can you tell me where I am?" And luckily a voice from below says, "Yes, you seem to be in a hot air balloon. Are you by any chance an accountant?" "How did you know?" "Because your answer was 100% accurate and 100% useless." Okay, and just to be fair, I've heard the same anecdote told about PhDs and MBAs. And as I have both of those, I'm in deep trouble. Okay? 100% accurate, 100% useless. You have to be very careful what you ask your accountant to do for you because they will tend to take you literally. What we want to know is how much cash have we got. We want to do effectively a cash budget. What this is a 2-month cash budget, which shows us we've got roughly £50 in the company. Okay? The Midshire won't pay us till the end of the month, and the whole bill has to be paid in February. So cash is not the same as profit. We get profit as soon as we send someone an invoice, but the cash only arrives when they pay us. Plus, when we buy assets, we don't take the amount that we buy of the large asset out of the profit, but we do depreciate it. Okay? But the big one is invoicing. Profit and loss accounts, what do they look like? A big sum like that. Okay. It's a convention to separate the different costs. Direct costs from overheads. Overheads are things like admin salaries, light, heat, power, insurance, those kind of things. If you see on a set of accounts the words or the cost of goods sold or cost of sales, it means all the costs of the raw materials, the costs of the packaging, the cost of the direct labor. And it's usually separated from the admin costs. One of the questions that you might be tempted to ask of SmithChem is this: how much profit do you make on each customer? Or if you're a chemical company, how much profit do you make on each product? That's actually quite a difficult question to answer. Of those costs, how many costs can we say were only incurred in dealing with one customer? The insurance? No. The rent? Not really. The travel. Right? Joe Smith traveled individually to each customer, so you can definitely say that the travel costs are to do with one customer rather than another. But then you're faced with all the other costs, which we would typically call overhead costs. And then the question is, if you want to do things like allocating or calculating a cost per product, you have to do this sneaky thing, which is taking all of those overhead costs and splitting them up. And all I will say about this is it's a very dangerous game. It's usually a game played by managers when they want to tell you that your group isn't performing efficiently. It's often a game played by rival managers when they go to the boss with proof that your department is inefficient. Right? I'm sure it never happens in a university that the physics department says the chemistry department are rubbish, right? But if it did happen, the answer would almost certainly be, how have you allocated the overheads? Allocation of overheads at universities is such a big issue that they have dozens of accountants sitting there just doing it. It's called full economic costing. Right? If someone ever comes to you and says, your department is inefficient, your first response is, how have you allocated the overheads? Your second response is probably to get on the phone to me and ask me to recalculate it a different way, right? Because we can do that. What does that tell us? Why am I telling us all this stuff? It is important in most organizations to know the different types of cost. And accountants will tell you that there are 4 types of cost. There are variable costs, and variable costs do not change. Variable costs do change if you sell more of the product. They change according to output. There are fixed costs which do not change according to output. There are direct costs which can be directly linked to a specific activity, and there are indirect costs or overhead costs which can't be linked to a specific activity. Right? So in theory we have 4 types of cost. In practice we usually get 2 types of cost, because in practice, variable costs are often direct costs and fixed costs are often indirect costs. Let me give a more specific example. One of my favorite chemical companies, Coca-Cola, right? It makes a chemical, it's just a chemical that we drink. The cost of the Coke, the liquid itself, the cost of the bottle, the cost of a label if it had one, the cost of the cap, the cost of the production line workers actually filling it, right? Presuming in a Coke plant, there are thousands of people taking a bottle and filling it like this, right? Those are all direct costs. They can be directly attributed to the drink. Right? They are also usually variable costs. If we sell more Coke, we need more bottles, more caps, more labels, okay? If you look below, we have a picture of a bottling plant. Do we need more rent at the bottling plant if we sell more Coke? Do we have to keep the lights on a bit longer? Possibly not. Do we have to change the insurance in the factory? Do we have to buy new company cars? We might, but do we have to? Right. So those things don't necessarily change. Right. It's not that they never change, but they don't change in proportion to output. So we call those fixed costs or overhead costs. Okay. That's an important and useful distinction. The next important and useful distinction relates to the size of the cost. Do you have a big item or do you have a small item? Do you have a big item in particular that's going to last for more than a year? Are you contemplating putting in an ammonia plant in your back garden? A quick $1 billion at least. Right? If you were, that would be a capital item. In your accounts, you would record the cash expenditure on the capital item, but for profit terms, you would depreciate that over the lifetime of the plant. And if it really was an ammonia plant, that would be about 40 years, because the steel is about that thick. On the other hand, you have revenue items. Revenue items are small items which are consumed quickly, maybe the stuff that you actually buy and sell. What's one of the main consumables in an ammonia plant? Natural gas. They need natural gas as part of the reaction. They use natural gas for heating the plant. They buy it, they burn it, they use it. Natural gas would be a consumable, it would be a revenue cost of running that plant. In most companies, there is, as well as a lifetime distinction, there is usually a cost distinction. Most companies will say anything under a certain amount we will treat as a revenue item even if we expect it to last for years. A test tube. What does a test tube cost? What does it cost these days? A few pounds? Right? A test tube is going to be a revenue item even if you manage to keep it for years and years. It might be your favorite test tube. Okay? Why is this important? It's because revenue items, the cost, gets taken straight off the taxable profit. When you buy revenue items, it reduces the taxable profit. When you buy capital items, because of depreciation, only a portion is. I had a friend when I was working at BP who was very ingenious and rather frustrated because his application to buy a new piece of laboratory hardware was turned down. We don't have any money in our capital budget. And being an ingenious person, he just ordered a lot of spare parts. He built himself, I don't know, a £5,000, £10,000, £20,000 machinery just out of spare parts. And he couldn't understand why the company accountant got cross with him. Why did the company accountant get cross with him? Because he'd ordered these spare parts through the revenue budget, the total cost of the machine was wiped off the company's tax bill. Right? What he was effectively doing, although he didn't realize it, was to cheat the taxman. And if you work in universities, large companies, one of the things that accountants get a bit twitchy about is what they call the capital asset register. All of the large capital items, they're supposed to keep track on them. They're supposed to know how much they're depreciating, because the accountants have to talk to the taxman about these things. Okay. So let's talk about doing cash flows and budgets systematically, right? We did it a little bit for Smith Chem. What you actually do is put them all in some kind of spreadsheet, a bit like this, where you've got capital, you've got spending items on the left-hand side and a time period on the right-hand side. Right? And this is a piece of Excel. This actually is a piece of Excel that I designed as a generic operating budget, and you can download it from my website. And it works, I think. So what we're doing typically is we will get asked to produce some kind of operating budget for our research project, for whatever. It's usually a cash budget. One of the nice things about it is, unlike producing proper financial accounts, profit and loss account, there's no format. Right? We can just design something that works for us. We can put as much Excel or as little Excel as we like. We can make cells change color. We can do all that kind of stuff. It doesn't matter. It is good practice to have a plan, and even better practice to have an actual spreadsheet. And if you really want to be fancy, you have a third spreadsheet, which is the difference between the two, which is called the variance. As you go through the year, you fill out the actuals. If you want to, you can link lots and lots of project budgets together to get divisional or corporate budgets. What's good practice in budgeting? This is good practice in budgeting. It's very good practice to separate capital expenditure from revenue expenditure. It's good practice to separate the activities out, if you're running a complex project, by manager, by section, so you can see what they're doing. It's extremely good practice to separate income from expenditure. In fact, it should be pretty much compulsory to put income at the top and expenditure underneath. It's a good idea to separate variable costs from fixed costs of the project. And then what you can do is, actually, as you start to run the plan, put in the actual expenditure, control it, and see what's going on. In spreadsheets, and these are spreadsheet models, the few things I always like to do, I always like to have a separate introductory page to my spreadsheet, which explains what's going on. And very often, I have a box with base assumptions. For example, in that box on the top left-hand side, you can see it says current interest or discount rate. And that's so my manager can say, what happens if that's 5%, not 10%? And what I have is that one cell, and every single cell that depends on an interest rate variable links back to that cell. And when I make spreadsheet models for clients, I will have one box of assumptions, which is typically the only part of the spreadsheet that isn't locked. I will lock all of the calculation cells so they can't fiddle with it, because they do. I actually, in some of my spreadsheets, I actually tell them, you can only change things within the box, so don't even try. The budget template that I've designed, that you can actually have off the website if you want, looks like this. At the top, it has income. So that's money. It could be money from a grant if it's a research project. It could be money from commercial activities if it's a commercial project, up on the top there. It then has capital expenditure. We know what capital expenditure is, money spent on big things. It's got revenue spending related directly to products. It's got revenue spending on overheads. And at the bottom, it's got a subtraction sum. And I don't know what we did in the days before Excel, but it does all the arithmetic for you. At the top line, I don't know if you can see it, it doesn't say month 1, it says period 1, period 2. So you can put in week 1, week 2, or month 1, or quarter 1, and by the magic of Excel, if you change it on the plan spreadsheet, it changes it on the actual spreadsheet as well. And what you can do for a typical project is produce some kind of cash flow picture. Because what you have at the bottom is a subtraction sum, And what you have at the very bottom is a cumulative cash flow. So you can work out how much money you've started with and how much money, how the money disappears through the project. And in the majority of commercial projects, you will see that that graph looks something like that curve. Curiously like a sort of electron density curve, I always think. But you usually spend money fast to start with, and as and when you get it back, it comes back rather more slowly. And this is the curve for a real project, and it's actually superimposed over a Gantt chart, which is what we talked about yesterday. This is very nice. And basically, that's how you do an operating budget. You take a template like that, you fill out the numbers, right? It's actually not a hard thing to do if you've got the right tools. If you understand the difference between income and expenditure, if you understand the difference between capital spending and revenue spending, and if you understand the difference between variable costs and overheads, it's not a problem. Where does it get a bit more tricky? Well, it can get a bit more tricky in the case of capital budgets, where we're actually thinking about spending money now and getting our returns back in 4 or 5 years' time. Right? Please give me £2 million for my biotechnology company. Why? Because in 10 years' time, I'm going to sell a drug to Glaxo for £50 million. I don't know if any of you ever watched Dragon's Den, that wonderful program, but that's basically the pitch that the hapless entrepreneurs are asking the dragons, right? Please give me a bit of money now and I'll turn it into a much bigger sum of money in the future. Okay. What's the process? How do you do that kind of calculation? You do a little budget, right? You use basically the same template that I've just described, except instead of month 1, month 2, it's probably going to go out to month 30, month 45, month 60. Right? It's going to go up for 4 or 5 years. And then what we can do is analyze the money that we get back in a number of different ways, and then decide whether to do the project. So what's a simple one? A very simple one would be something like this. We want to build a new ammonia plant. It costs $1 billion. We might make $50 million a year off that. That's 5%. That's a 5% return on capital, a 5% return on investment. Why is that a useful thing? Why do companies talk about return on investment, return on capital employed? Because for the investor, you can directly compare that with return on other things. The return you make on an ammonia plant, if it's 5%, you can compare that directly with the amount of money you could get by putting money in the building society. It's like that 1 or 2% return. You could compare it with, rather than putting my money in an ammonia plant, I could do something safe, like lending it to the government. I think that's safe, isn't it? Okay? Right? You can make those direct comparisons. So people talk about return on investment, return on capital. Okay, fair enough. Supposing the project, though, I mean, curiously, it doesn't actually take all that long to put up an ammonia plant. You can kind of do it in 1 year and get some return coming in. Supposing you get something like this. You spend 500 million in year 0 at the start of the project. Next year you start to make a bit of cash. You make 100. And then the following year you make 150, and the third year you make 250. Right? It's actually taken you 3 years to get your money back. A break-even point. A payback period. So another thing that bosses often want to know when you propose to them a piece of capital expenditure is how long will it take to get my money back? And what will they do? They'll compare that almost directly with the length of time they expect to be in their current position. That sounds cynical, but if, for example, you go to a politician and say, well, I think we should build this bridge, it'll take this long, instantly they'll be thinking, is that before or after the next election? Right. So one of the things you always need to calculate is what's the payback? How long does that curve take to get back to its starting point? All pretty straightforward so far. Return on investment straightforward, break even pretty straightforward. Right? But what about this situation? What about the smart aleck investor? And if you do watch Dragons' Den, it was usually James Caan, because he does this for a living, would say, look, you're offering me £10 million in 10 years' time. That's not the same as £10 million now. Right? I would rather have £10 million now. That's nothing to do with inflation. It's just that if I invest in your company, I lose the opportunity to invest in other people's companies, other projects. There is an opportunity cost to me. I could do other things with my money. I could do something very safe, like lending money to the government. Okay, the British government hasn't been derated yet. But if I lend my money to the British government, I would get, at the moment, 3.5%. And historically, I would get typically 5%. Over the years, that 5% that you can get by buying or lending money to the British and American governments has actually been used by economists as the very definition of a risk-free rate of return, which is why governments are starting to panic at the moment, okay? The British government, for example, has never ever defaulted on repaying its investors, right? Just a few years ago, it repaid the last of its 50-year bonds it borrowed to function in World War II. So, if we could get 5% without any worries, we should get a bit more investing in a company, shouldn't we, in a project? So what we should do, if someone says, I'll give you £1 million in a year's time, we should kind of take 5% off to calculate a value now, shouldn't we? And if they say it's 5% in 2 years' time, we should take 5% off twice. So what we have is a kind of compound interest sum going backwards. And if we go 3 or 4 years, all right, we're going to be getting into sort of power terms. Right? And that's what we do. We can calculate a thing called the present value or the net present value of a series of cash flows, where the net present value equals the money that you get in year 1, divided by 1 plus the interest rate or the discount rate, raised to the power of 1. And in year 2, it's the money we get in year 2, divided by 1 plus the interest rate raised to the power 2, that's squared. And so on, okay? Which looks a complicated and scary calculation. But again, that nice Mr. Gates comes to our rescue. It's a function in Excel. You can calculate net present values, and there on the slide as a little example, right? You put in equals NPV, and you put in the discount rate that you want. You have to be a little bit careful about the timing of the outgoing cash flow. Is it in year 0 or is it in year 1? But it's basically a straightforward calculation. And when you look at something like, let's take a profit of £5 million, a cash flow of £5 million in X years, okay? And if we discount that at 10%, okay? If it's 1 year away, the present value is 4.55 million. If it's 2 years away, it's 4.13 million. If it's 3 years away, it's 3.76 million. 5 years, it's 3.1 million. 10 years, it's 1.9 million. Okay? So the further away the money is, the less the present value is. Okay? And 5 years, at 10%, it's 3.1 million. If we discount it by a larger amount, at 20%, that 5 million doesn't become 3.1 million, it becomes just over 2 million. And if we discount it at 30%, it becomes 1.3 million. James Caan was doing this kind of stuff in his head, right? Because the investors were saying something like, I'll offer you 5% of my company for £5 million, and he's saying, no, I'll offer you about £500,000 and I want 40% of your company. Right? That was what he was doing. What kind of discount rates do you actually apply? If you're the government, about 3 to 4%. If you're a bank or an investor lending money or buying shares in a large company, about 10%. If you're an investor lending to a small business startup, then it's actually, you're looking for about 30 or 40%. Right? This is high risk. You're going to lend to 10 companies and probably only one is going to survive. Another way of doing the same calculation is to see how bad the discount rate has to be to kill the project. So as we increase the discount rate, the net present value gets lower and lower and lower. And there will be a point at which we can reduce the present value of the whole project to 0 by applying a steep enough discount rate. And that is called the internal rate of return. And again, it's an Excel function. And again, there is an example of the calculation. Right? It's a useful shorthand. What's the internal rate of return of this project? It's 19%. That means you have to apply a discount rate of 19% to kill my project. It's better than his, because the internal rate of return on his project is 16%. It's not as good as hers, but we don't like her anyway. Right? It's that kind of conversation. Right? That's what these things mean. These methodologies together, net present value and internal rate of return, are called discounted cash flow methods. Right? Because what we're doing is discounting future cash flow. This methodology is used by governments, it's used by large companies, it's used by investors, it's very widespread, particularly since the advent of spreadsheeting. What are the implications of it, though? Most companies will have what they term a cost of capital, what it costs us to get more money from the banks or the shareholders. And it's often bigger than you think. You might think it would be 5% and it's 10%. You might think it would be 10% and it's 15%. Right? And so they'll only look at projects that have an internal rate of return greater than a certain amount. The smart ones, if you might say, well, the costs will get discounted as well, but the costs tend to be in year 1 or year 2, and the revenues are in years 4, 5, and 6. So the costs don't get discounted as much. And a criticism of this methodology is it leads to cautious investment decisions. It's also very sensitive to interest rates and market volatility. It's particularly sensitive to interest rates. You can see what's going to happen. If interest rates go up, then discount rates are going to go up. And that's the real stranglehold that you have on the economy. Increasing interest rates slows down capital investment. And one company's capital investment is another company's day-to-day business. Right? Your capital investment might be a new house, but for a building company, that's what they do as a day-to-day living, build houses. What we have at the moment is a situation where the government or the Bank of England have lowered the interest rates from the Bank of England to the banks as low as they possibly can, but in the real world, banks are not lending. Banks are still charging 10, 11, 12, 13, 14%. Right? We're possibly in a the worst situation for a while on that. But last couple of slides. For anyone writing business plans, writing operational plans, it's nice if your costs look vaguely realistic, right? So they won't just kick it out. If you want to build a large petrochemical plant, like an ammonia plant or an oil refinery, it's going to cost you billions, right? And you can produce all sorts of sums and spreadsheets, but if it doesn't come out with a roughly $1 billion cost for a large piece of chemical plant, I'm probably not going to believe it. Okay? If you just want to build a pilot plant to prove your technology to investors, that's probably going to cost $100,000 to $1 million. If all you want to do is employ a nice, smart, recently qualified PhD and have them in a decent laboratory somewhere in Europe, that's going to cost you roughly £100,000 a year by the time you've got all the overheads on top of their salary. 20 years ago at BP, our notional charge-out rate was £72 a man-hour. Right? If you just want to rent modern laboratory space, it's going to cost you between $20 or $30 a square foot in America, 20 or 30 pounds a square foot in this country. If you want to know about small-scale reagent costs, there are some wonderful people called small-scale chemistry from Colorado State who have lots of laboratory experiments costed. Other real costs. If you're interested in drug development, clinical trials, phase 1 is going to cost you $1 million just to prove it doesn't poison people. Phase 2 is going to cost you $10 million just to prove it might work. Phase 3 is going to cost you getting towards $100 million to prove that not only does it work, it's better than the placebo and better than the other treatments, and the side effects aren't too bad. If you want to hire professionals, lawyers, accountants, yeah, budget on about £100 to £200 an hour. It makes me feel really cheap, I have to say. If you want to go to a conference or a trade fair, you want to have a stand. It's an international one. Budget 10 grand. If you want to have a marketing campaign that is aimed at consumers, not companies, then budget between 10 and 100 million pounds. If you want investors to invest in your company, and you're a big company, then they'll be discounting their investments between 10 and 15%. If you're a small startup and you want investors, they'll be discounting at about 30 or 40%. Okay, final slide. Things you should know. You should know, 1, the difference between profit and loss and a cash budget. In SmithChem, the profit for January was £2,500. The available amount of cash to spend in February was what? £50. Why is it different? Mainly because we take profit as soon as we invoice people. You will see on company accounts something called debtors or accounts receivable. That's all the people that we have invoiced who haven't paid us yet. And it can be a big sum. The difference between a variable cost and a fixed cost. A variable cost like the Coke bottle. The fixed cost, the cost of the air conditioning at the Coke plant. The difference between capital expenditure and revenue expenditure. Capital expenditure, the huge ammonia plant. The revenue expenditure, the natural gas it consumes. And the final thing is how to prepare a project budget using a spreadsheet, using, if you like, discounted cash flow methods. One of the things I have, if you're interested in doing DCFs, you could email me. I have a version of that Excel spreadsheet with the DCF calculations kind of in place. So you just have to put the numbers in. Okay? And I will finish there. Thank you very much for your attention.